you're going to make me the bad guy on your show, right? I'm going to say no. Not if you owed them money, you're out of school, you were supposed to be paying them. So, no. If you ask them to run that back, the answer would be no.
Okay, guys, so we are here at the Monument Community at Reverence, which is located in Summerlin. I have my special guest today. I have Mosaic Gatling with New American Funding, and she is in charge of strategic growth and expansion. Welcome to my channel. I'm so glad for you to be here with us today.
Thank you. I am so glad to be here. It's so important for us to talk about what it's taking to buy right now, not just in our market, but the market of your viewers as well.
Awesome. I feel like this area is in it's a secluded area. I didn't even know that this was over here.
I didn't either. Monument is by Pulte Home, and it's nestled right at the base of the mountainside. Newer area, great community, but I think what's super amazing is the prices.
Yes. So I heard that there are specials, move-in ready homes. Can you please, elaborate with us on that?
Yep. These are attached homes. We could call them townhomes. They have homes in the 400s out here. And I know there's such a look out there for more affordable housing in the valley, but here you're getting affordability with luxury because we are in Summerlin and it's an immaculate location.
It sure is.
Yes. And they have financing specials as well that they're offering all across the valley. Those are subject to change. But the value of the homes starting in the 400s, I don't think a lot of people know because they're looking in other places of town and getting that same price point without the location that is so coveted by people here in Vegas.
I'm very used to showing a lot of Summerlin homes, and we're at the 6, 7, 800,000 just for a townhome. So this is really a surprise here at this community.
Definitely a surprise. When I pulled up today, I was amazed, and I will want to give Pulte a shout out to allowing us to do content and video in their model home and providing us such a beautiful place to do what we do for a living and let everybody see some of the background here of this beautiful house.
So I'll be showing you how these models look exactly. And if you are interested in this community, please put a comment in. I would love to help guide you with this wonderful lender. She can get the loan for you. I can help you get this home. There are move-in ready homes for those of you who are relocating or is just in the valley and want to move here. We would love to get you here. So Mosaic, can you share with my audience exactly the pitfalls that you run into repeatedly of why some clients may not be able to get qualified?
Absolutely. Anything that we can share so people can avoid what somebody else did.
Right.
They don't have to start from scratch and make their own mistakes. They can learn from the ones you and I see day to day. I would say, number one, people trying to DIY their home process. I know there's so much information on the internet.
So much, way too much.
Yes, but there's no two scenarios that are alike. So if your auntie bought a house and she tells you all the ropes, it's based on her specific credit profile, what she had as debt, and what she makes as income. It would be hard to layer that on top of your scenario unless everything that you had was identical. So there could accidentally be errors there. That's why talking to someone and identifying your specific scenario is so important because there will not likely be two people identical and alike. So you can learn and absorb, but if you take that on to your personal scenario and think that's law, and then you show up one day and say, I'm ready to buy a house, and you find out it didn't exactly work how you thought, it was just because There's no two scenarios alike.
So what you're saying is that instead of me trying to, or my audience, trying to figure out get my credit score high and try to pay off all these things, I should just come to you first.
Correct. With technology right now, what I think is amazing is I think a lot of people may see it in their actual day to day. You can get qualified for something without a hard credit pull. These days, you can do that with a credit card, you could do it with a vehicle, and you can do it with a home. Uh, it's what we call a soft credit pull in the business. So if you ever hear that terminology, that's what that means. I'm going to take a peek at your credit without causing a hard inquiry, which means we've taken all the angst out about, I don't want my credit pulled, to be able to tell you specifically in your life what you can do. Do you qualify for the program you want or the down payment you want? All those things in home mortgage are dictated based on your credit score. And without me seeing your score, I can't really gauge it. And even if you heard from somebody else, what if it's not right or true? Or I think the biggest misconception when it comes to credit is there's so many ways to monitor your credit for free.
Mm-hmm.
None of them contain the actual mortgage score that I'm required to pull to give you a mortgage unless you're paying for it.
If I go to like Experian.com, and I'm not even going to say Credit Karma, but Experian.com, and I see that my credit score is, let's say, a 650, for example, that's not my mortgage score?
No, most likely it's not. There are different scoring methods that were developed by FICO. And remember, FICO is a private company. It's Fair Isaacs Corporation. That's where FICO comes from. They are a for-profit company. You can go to their website by going to myfico.com. They'll tell you all the tricks of the trade when it comes to credit scores, period. And it's good to go there and look at that. The reason why is they made the scores. They made how your credit will react to what you do. They're the originators. Everybody else just reports it. They are the originators. So when I say that is there are mortgage scoring methods, 5, 4, and 2. Okay. They do not show up on the free credit reporting. They are reporting credit card scores.
Okay, so real quick, you said 5, 4, and 2.
Yeah.
Can you please break that down?
Yes, there are different scoring methods and they've given numbers to them. Okay. So when you're looking at your free credit report, most times you get FICO scoring method 8 or 10. And those are identified as being the score methods that actually report on how your credit score looks if you're getting a credit card or say a small unsecured loan. And the reason why I say that is typically when you get payments on an unsecured loan, that might be amortized over 5 years.
Okay.
So it's like, how can this person handle a payment for 5 years?
Right.
You hop in my world with mortgage? No, that's a 30-year fixed mortgage in most cases, right?
Right.
It's such a much longer period. Auto loans also have a different scoring method. I don't know that number right off since that's not my world. But if you go to look at your free credit, it's not what it looks like if a car dealership pulls it. Because again, it's a different period. You're looking at 5 to maybe now these days, 8 years on a car.
True.
So it's been specified to the type of repayment and commitment that you have to have in order to pay back the loan. So when you're looking at these free credit reports, you just don't get it. Trust, I hate that people can't see everything for free, but you don't get it. And if you go to the credit monitoring services, the Experian, the Equifax, and the TransUnion, you can pay to see all the scoring methods, and each cost about $20 a month. Each one, and there's 3. So yes, that is in fact $60 to clarify per month if you wanted to see all the goodies. Okay. If you do go to myfico.com, which is direct because I do pull a FICO score, you are able to pay approximately $40 a month for the same thing. It's a little bit cheaper because you went to the originator to see it, but that's how you can look at those mortgage scores. Because if I say, what do you think your credit's at? And you say, hey, 700, remember, you're telling me on what it looks like if you're taking out a debt that's 5 years to pay back, not 30. Okay.
Got it.
So on those mortgage scores, things that are more relative and impact them more are how you handled an auto loan because it's a longer period. How you've, say, repaid student loans. It actually is affected more by a late payment on a student loan or a balance on a student loan than the free scoring method that someone might be looking at. So there could be differences. Or if you've had a home before, your mortgage FICO score could be higher because you paid something that's more relative to the period of repayment that's required when you take out a mortgage.
Got it. So what you're saying is that I can use all these free credit reports as much as possible, but it's not going to really give me the score that we would need in order to actually qualify.
Correct.
So that brings me to asking then, how soon then should I contact a lender such as yourself to be able to like get this process together? And the reason why I'm asking is because as a broker salesperson, I get a lot of clients and their lease is up in the next 3 months. and sometimes that's too short of a notice in order to figure some things out. And then now they're stuck with, having to sign a lease for a whole other year. And so many things can happen within that year that they could still be put in a position where they're circling back for signing another lease for another year. So now they're in this little race, this little circle that's not allowing them to be able to actually get pre-approved in a good amount of time, and then them actually being able to execute on buying a home. So how soon should someone come and speak to you as a lender?
I agree with you so much. 3 months isn't always enough to really prepare.
Mm-hmm.
Preparation is what really helps you get into the house. So if you're with a good mortgage person, they shouldn't mind if you come to them and ask them for guidance or an assessment of where you stand 6 months or as much as a year.
Mm-hmm.
Because if you just signed a lease, that's a great time to plan the next 12 months on your next move.
Mm-hmm.
Find out where you need to be. Do you need a tax preparer? What is your score? Is there anything you need to work on? And this isn't just for people that have low credit. That's what some people think.
Mm-hmm.
Mortgage, your score, your mortgage credit score is going to affect what program you can get and the rate. So even people that have a 700 FICO, you're still going to get a better loan and a better price if you have a 740.
Okay.
So the misconception over, oh, well, my credit's fine. That's good, but you still pay a price based on where your score is. So why not have the best that you can have, even if it's a couple little tweaks? And then you also find out how much the house that you're thinking you need to have will cost you, and you can prepare for that. You could be able to save or get a budget going while you're leasing. The preparation while you're leasing is really what's key. Makes the process so much smoother. And again, you don't have that disappointment or misconception about what it's really going to look like.
If I heard you correctly, not 1 month, not 3 months, but as far out as 12 months in order to actually be prepared in order to purchase a home.
Absolutely. As far out as 12 months, you could have just signed that lease literally and say, okay, I know my next move in life is going to be buying. So as soon as you get moved in, the boxes are unpacked, you can call somebody and start that preparation so you have a plan in place to be able to execute. And then it's so much smoother for you as well. And you know exactly what your goals need to be the next 12 months, from how much money it's going to take, where your credit needs to be so you can get the best pricing. And then you have a great idea of what's going to cost you to own as well.
I love it. So viewers, just to recap what she was just explaining is that not only is it up to 12 months for you to get prepared in order to purchase a home, they can even do a soft credit score. So now you don't have to worry about getting your quote unquote credit ran for your credit score to drop. Now you're going to be able to know where you're at, where you need to be, and you'll have up to a full year to be prepared to buying a home. I like that because that really does make it more of a smoother transition. It allows me as the agent to help prepare the client in knowing what's out there in the market and everything. And hey, if something pops up even sooner, then they'll be able to have time to execute.
Yeah, you know what I say, if you stay ready, you don't have to get ready. And that's exactly the way that you're going to get it done.
So what would you say should be a person's first home? Well, like ideally, what should that look like?
It should look like what you can afford and what your goals are, not what used to be someone thinking they needed to have 4 bedrooms, a pool, 3-car garage. It's supposed to more align with your goals, because affordability is something that everybody is chasing right now.
Mm-hmm.
you got to go with what's good for your pockets all day long. So that's why you need to talk to somebody and get that aligned first and foremost before you paint the picture of what the house is going to look like. It leads to disappointment in qualifying because, again, your pockets have to align with that house too. And you get discouraged on whether or not you should buy or not. So your first home doesn't have to be your forever home, but it is a way to make your first home your first investment. And when you buy an investment property, you can't have those emotional connections to the house itself because you're thinking about the long game. So it is smarter to make sure the pockets are aligning with what that house needs to look like before you paint the picture of the house.
Got it. So, like, what about the renter who may be renting like a really nice house for like $25 to $3,000 a month, right? And then they want to buy, and then they realize that, you know, even a $2,500 or $3,000 payment is not what they could rent. Like, how do you kind of help those type of clients adjust into understanding how to kind of take a step back in as far as what they would qualify for in order to start that first investment?
First, we start out with prayer because we need to pray over you. Because the thing about renting, it's much like renting a car. You're not paying the full car payment while renting a car, are you? It's
Right.
spliced out. It's subsidized because you don't own it. You have to give it back.
Mm-hmm.
The same applies to a rental. You're not paying the full amount or the full expense of the home or the current market expense if you were to buy it today. You are it's subsidized. It is less because you do have to return it. So if you go into that mindset when you're renting, you're paying a fraction of what it truly costs to own that home. And that's where the conversion sometimes is harder to digest
Right.
for people. So we talk about that. We have a lot of maybe education to do in a way to let them know really what's going on and to give them that perspective. And sometimes talking about the car scenario is a very good comparison for somebody to get in that right mind frame when it comes to what that expense may be. Because they're not going to pay the full expense renting. You just simply don't. And it's because you got to give it back.
Now, I like how you brought that up, how it's a fraction of it, because I do feel that renters really believe that they're making the mortgage payment, quote unquote. And so it's like, how dare I have to, not get what I'm paying for? So I really like the fact that you brought up that no, we're just paying a fraction if
It's
you're
literally
renting.
a rental. You are paying for use of the product. And anytime you rent, you're not paying the full thing. You're paying a usage fee for something you in fact have to return. Okay? And that person's going to do all the replacing of everything that's in the home. They're going to maintain it. You get it for a fraction. So there are rentals that allow you to do that. But when you're talking home ownership, think of the difference in payment. Not that your payment's going to be higher because someone wants to charge you higher. It's because you're paying to keep the property. Okay? So that's where the investment part of ownership comes into play. No, you're not going to pay the rental fee for an ownership. You have to pay the ownership part as well. So that's where that payment is going to be made up of. So the conversion of someone going from renting to owning, yes, that payment could be more, but that's your personal investment into the property so you can keep it. And now when it's your turn, you can do the same to somebody else, right? If you convert that property into a rental, because even if you're buying and it is in fact your first home, you can do the same as the property that was once rented to you and turn around and rent it out to somebody else to help cover the payments on your investment. I think that a lot of people have this misconception of what purchase prices versus payments actually equate to. And that American dream has changed. It's kind of evolved, let's say. The dream is to not be in debt and to have freedom. So they need to be able to accomplish both now, right? Have the freedom, not be up to their eyeballs in debt, but also be able to have home ownership so they don't have to consistently move and they can build on that and also build wealth. So when it comes to that, I think more or less before you get your mind set on anything at all, when it comes to buying a house, you gotta consult with a professional.
Right.
Because if you don't, then you have something in your head that may not come true. And that's when disappointment sets in. So talking to someone like yourself, like a real estate agent or a lender like me, it doesn't commit you. And that's another misconception. By talking to someone, you're not committed. You just want to know what it's actually going to take. And by consulting with somebody and having those ideas of payment, then now you know exactly what you can purchase and you don't have that disappointment because the two don't align.
Okay, down payment assistance programs. You know, there is a full idea that you, in order to do down payment assistance programs, you have to be broke. And that the interest rates are really high, so that it makes it to where there's not too much of an advantage of the down payment assistance. Can you kind of like give us some insight on that?
Yes. Again, you like to make me the bad guy, but I'm gonna play the role here, cape and all. Okay, let's go. Down payment assistance. There's so many different programs.
Okay.
And there's different programs depending on who you talk to, different agencies. There are down payment assistance programs I don't have that maybe a credit union has. Okay. So it's all about interviewing, getting opinions. Okay. There are down payment assistance programs that, in fact, don't have an income limitation. So people take them out that make a couple $100,000 a year. Okay. There are down payment assistance programs that don't have high thresholds for credit score either. Okay. And then there's not a lot of restrictions when it comes to the type of home you can buy. So yeah, there's so many options that are out there, and it is not for people that just don't have the money for the down payment. I know it's always been prefaced like, oh, if you don't have money, come get this. But right now, if you have money in the bank, but you need to pay for kids to go to college, maybe you just use it for that reason. You know what I'm saying? So there's all these ways that you can leverage that to keep the money that you have in your pocket, because that's really what it's about. So sometimes I think people that have money in the bank that qualify for the programs don't gain access to them because people think, oh, you got it. You could just spend the money. I don't have to go through the extra step that I have to take. The buyer doesn't actually have to go through an extra step. It would be me as the lender. So it doesn't impact the buyer to be able to keep money in the bank for other things that they need to pay, whether it's their savings or their nest egg or emergency fund, putting kids through college, or just, again, having that there for a rainy day, or even treating yourself to go on a trip.
Nice. Okay, guys. So, I mean, if you guys are interested in a down payment assistance program, please comment down payment. And I know that we can literally talk about down payment assistance full on. So if you also want to bring Mose back about down payment assistance programs, I know that you have special programs with your lending company as well. And as you had mentioned, that not all lending companies are the same. So it's about doing that shopping. But real quick, when it comes to shopping, how long should a person shop around to different lenders without it really affecting their credit score?
With the soft credit pull, it's not going to impact your score because we're not fully pulling your credit. So it's maybe checking with maybe a couple different lenders, taking the recommendation of your real estate professional. Your agent is going to have maybe 2-3 different lenders. And the great thing about agents like you make sure you have people that are different and offer a range of different things, because there's a difference between a mortgage company and a bank and a credit union, right? There are differences in what we have to offer and give, or programs that we have access to. So checking with at least 2 is always good, so you can find what's your right fit. And with the down payment assistance programs, a lot of people think the interest rates are higher than normal. With some down payment assistance, and I speak from the programs that I have, of course, and not everybody else's, we have programs that you can actually buy down the interest rate. And that's going on a lot right now.
Okay.
And you probably can speak more to that, about the number of homes that you see that are on the market that you can either negotiate closing costs to be paid. That's how the rate's bought down. Basically, you're paying for the rate to be a little bit lower by way of the seller giving that additional incentive to be able to buy. So the rate also doesn't have to be higher to take advantage of it. So it is worth weighing, or at least looking at.
Okay, sounds good. So guys, down payment assistance programs are actually a good thing if you can qualify, and there's so many different ways to do that. On our next segment, I definitely look forward to us elaborating more on that. Student loans. Now, during COVID, a lot of the loans were deferred. And so I feel that a lot of people have just forgotten about it. Matter of fact, they didn't think that they had to pay anymore and that it was just going to go away. However, recently, it's coming to haunt a lot of people, causing their credit scores to drop because now they want their money.
Yes.
So can you please elaborate about what's happening for my viewers who have student loans and how that can affect their home ownership?
Yes. Basically, the government is saying, run me my money.
Wow.
It's the truth. Right now, the government is trying to cost cut. They're bringing expenses in line for the federal government. Part of that is making sure each branch of government or anything government ran is functioning correctly, and that is student loans. So they are paying attention to it. There are deferments that were given, partially because of the pandemic, some because people were in school and they didn't enact repayment.
Mm-hmm.
So, yeah, you got to go back and pay now. And they are going hard and fast when it comes to the rules. I've actually had a couple of buyers that I've ran into the last couple of weeks that have seen the change in their student loans, and it affected them really negatively because they weren't aware.
Mm-hmm.
And I was able to find out some fun facts. I guess they're fun as you're finding them out because it was a surprise.
Right.
We found out that the student loan company, they're not necessarily mailing notices. Okay. They're emailing as well. So if you did not have your information up to date with the student loan servicer, you may have not gotten the notice. So that's your last email on record. One of my buyers said that they had to get a new email and they simply were locked out of the old email account. So they just started a new one. So they didn't have any notification. Or you didn't update your address with the student loan company thinking, hey, they'll find me or it would get forwarded. But if they didn't have anything to send you at that time, the notice didn't get forwarded and got returned to them. So that notification that you are no longer in that period where you qualified for that special pandemic era deferment or forbearance is up.
Mm-hmm.
And they went back and retroed some of that payment reporting. And that was the hard hit. So remember, there's rules to having a deferment, a forbearance, or income-driven repayment. And you got to look those up. We can kind of go over them if you like.
Well,
we would like to expand on what that looks like.
So what I do want to say is when it comes to student loans, I feel that people get them. And because people are not taking the student loans serious, like they'll take the government's money and I do know that they for sure signed that they were going to repay it back, whether it was once they got their job or once they finished school. But there's just not a lot of people that really take this seriously about actually paying them back, right? So now it's affecting their home ownership and them not being able to actually qualify for a home. So at what point do you feel that maybe someone should kind of have a second guess about or a second look at, should I take the student loan out or not? Like, what do you think about that?
That's rough. I have feelings when it comes to student loans because I think at 18, 19 years old, man, it's hard to think about what you're going to be when you're 30. Okay. And then to imagine what you might make after you graduate to see how that repayment's going to affect you. It's hard. So I don't know if people that young are even really mentally equipped to handle that decision, especially when you're talking about that much money. They can't borrow a car for 40 grand or 50 grand, but yet they're able to borrow a student loan that has all these intricacies without even having a job, just to try to get to the point of having employment. I know we could do a whole hour on that alone.
Yeah.
Because I've got 5 kids, and I have to navigate that with them and talk to them about, well, these jobs make this amount. Do you want to go to school for that? Especially paying to go to school. But again, I'm in the business. I'm in the industry of finance. So we have in-depth conversations, and a lot of people didn't have that guidance to really make those decisions. So I kind of look at it, it's not to fault of their own. It's just the system was set up to allow them to do it. And those rules are, in fact, in those original agreements. So a deferment is only when you're in school, and you have to be in school more than half time to be able to get it. If you stop going to school, boom, you need to pay your payments unequivocally. There could be a special time where it's like, oh, hey, we're not going to make you make it right now. But again, when they come knocking for their money, you have to be prepared to pay it. A forbearance is when an emergency happens. So you become unemployed, you become sick and can't work. That would be, they give you a temporary forbearance because you've had a loss of wages in your life, family emergency, a death in the family, and you have to take off bereavement time. That's where you would go and apply for a forbearance. They may ask you for proof of that instance, okay? And then you can have income-based or income-driven repayments, which they're trying to evolve what that looks like now and when they're allowed, because the bottom line is, like I said, they want their money. They don't want it. If you take it out when you're 19, they don't want it when you're 60. Right? There's a place and a time and a term, which is typically 15 years that you have to repay that. And everybody's been able to extend to the point where the federal government actually sued one of the student loan services for allowing people to go into deferment and forbearance, which I guess is true because I see people that are in their 40s and 50s that still have student loans that were taken out when they were 20 years old. And honestly, it shouldn't be, right? Not if they had a 15-year repayment. How many times can you defer or forbear them? And that deferment after graduating, they're deferred for 12 months. So you're supposed to start paying 12 months after you get out of school, which cannot be the case if this many people owe on student loans. It's a huge economic burden for people that don't have the means, or their family doesn't have the means to pay for college in cash, which is most of the average working Americans with the cost of college.
Right. So would you say that, so for the viewers who may be in a position where their credit is perfect, there's nothing else to do but handle these student loans, what would be the first steps for that?
First steps, grab out your student loan paperwork.
Okay.
Set aside some time so you're not in a rush, because I think a lot of people are probably calling the student loans, but go do a check of your student loans. Call them, go through them, ask them what type of repayment plan they are on. Make sure you understand your original contract, or ask them for the copies, or go online and find the information. The data is going to be what helps you.
Okay.
And if you're not paying and you're not in school, so let's just say that if you're not in school, you should be paying. That's the rule, right? So if you're not, set up something immediately. Figure out what payment plan you can get on to start paying them something, so it doesn't end up biting you. Like I have unfortunately seen some people go through major FICO score drops. Major, I'm talking 200-300 points.
Wow.
And the reason why it's so dramatic is every semester you pay for on your credit shows as a different independent loan. So if you went to school for 4 years, that's 8 semesters minimum, right? If you didn't take a summer semester. So you would have 8 minimum student loans. So imagine 8 student loans all of a sudden saying you've been past due for 2 years.
Wow.
So that's what I saw, and that's what caused a more than 200-point drop in FICO score to someone. So being in tune with what you owe, even though I know it's out of sight, out of mind, it really is, because they put them in deferment, or there was a button you can click online, but you need to know that you qualify for it, since everybody is, catching that L right now. They're catching that loss when it comes to the government saying, oh, this is what you signed for. It was only supposed to be this amount of time. Boom, you're late. Because they figure it's your debt and you had the responsibility. I did even have the person call and see if they can maybe get the lates removed. They said absolutely not.
Oh, great.
Okay, absolutely not.
So a credit repair is not going to work.
No.
I mean,
here we go with the credit repair thing.
I gotta ask.
You gotta ask, like, you're gonna take me there. Like, I'm gonna be the bad guy here on your show, right?
We just want to know.
You know what happens if you come to me and ask me about credit repair? I'm gonna ask you, first of all, did you sign saying you were gonna pay them people back?
Most likely the answer would be yes, because they did go to school.
Okay. Imagine asking the federal government, hey, can you just roll that back for me? No.
Because it wasn't me. So a credit repair is not gonna fix this?
You're going to make me the bad guy on your show, right? I'm going to say no. Not if you owed them money, you're out of school, you were supposed to be paying them. So no. If you ask them to run that back, the answer would be no.
Okay. So I'm sure that we can do a full segment on just student loans alone. So, my viewers, if you guys want to know more about student loans or have me do a whole segment on it and bring Mose back, drop it in the comments and we will definitely bring Mose back for that. So Mose, I would like to give a good example as far as like how a person is actually qualified. So let's say we have a husband and wife. They have a 10,000 a month income. Credit scores are, in the about 650. What factors, if they're making 10 grand a month, would it take for them to actually qualify? Or, I mean, how much of a home could they qualify with $10,000 a month in income?
Okay. I'm going to give you the long route to that, slightly long, only because it's going to depend on, let's say if they had good credit or what have you, but will shock everybody, I'm sure. So when you go to an apartment and you lease and you walk in the office and they ask you, they'll tell you what it takes to qualify. Believe it or not, the same is actually for a mortgage.
Okay.
You have to make approximately 2.5 to 3 times the mortgage payment to be able to qualify for the house. And that's exactly what it takes to rent an apartment.
Okay.
So a lot of people don't think that way, and they think when we're qualifying someone, there's the preliminary check boxes, and that's one of them. We also look at your credit history, the credit depth, and your stability in your job and your payments to other people. But if somebody made $10,000 a month, let's say $3,000 a month, 2.5 times that would fit nicely in there, right? Okay. So you can think of $3,500 a month in a house payment or less, that person would qualify because it meets that 2.5 to 3 times the monthly payment within their monthly income. And that's literally what we look at.
Okay. But what about the family that, because I've had, some scenarios where a family can make 10 grand a month, but they don't qualify for that 3,000 a month sort of a payment. So what factors would keep them from being able to be qualified at that?
That's a great question. That's when we kind of get into the credit and other debts that they have, because we look at how much the house payment is. And some people use a lot of fancy words with explaining debt ratio, and I think that's what throws people off. So instead of saying your debt ratio needs to be X, we have a housing ratio. Okay. And that's that 2.5 to 3 times the monthly payment. That's a housing ratio explained. Okay. And then when we talk about your debt ratio, we look at the new house payment that you're going to pay or that we're proposing that you get, plus all your other debt. That's what's the wild card from person to person and makes no two people alike for qualifying. Because it really depends on what your existing monthly payments are in combination with the house that we're proposing to get you qualified. Okay. So there's 2 factors you really have to check, kind of, or fact check against what you're making to figure out if you're a good candidate for a home. And I'll throw in there, what you're renting may not be or convert to what you can buy.
Okay. So wait a second. What do you mean by that?
Okay. I'm going to tell you the trick when you're renting. When you're renting, you have to put everybody in the household that's over 18 or over, on your lease. I'll give you an example. Putting everybody in my business. I have a daughter who's 22 that lives at home, and my mom lives in my household as well. If I were to go rent an apartment or sometimes lease a home as well, they tell me I have to put my mom and my daughter on my lease because they're over 18 years old. Right. Okay. What happens on accident is they don't just count my income in that lease. Because I've added them, they want to know where they work and how much they make too. So technically, you're taking out an apartment lease and you're using 3 incomes. Okay. Buying a home doesn't work like that. So I've had people that have 3 or 4 people in their household because they have grown children or they're married, right? And one person comes to me to apply for the mortgage. And they want to know why they can qualify for an apartment at the same payment, but I can't qualify for them for the mortgage. And it's because you've got 3 technical people on your lease and you're asking me to qualify only one of the 3 on a mortgage.
Yeah, that makes sense.
Yeah. So sometimes it's a way to leverage that, but just knowing the game is so important, because if you know how people are looking at you and qualifying you, and you asking me that question, we can give all of your viewers the tea and let them know what that looks like so they can be more prepared when they walk into lease, okay, or buy a home. Either way, you know what we're counting when you come to the table.
Okay. So is it better to just add those other two people who were living in the apartment, to just add them to the loan to be able to qualify for something better?
To qualify for more, it may be a good thing to add them. I think at that point, because we're talking about ownership and it's long term and you're taking out a 30-year mortgage, you can reevaluate who's currently living in your household. But knowing that means you're not going to be disappointed because a professional like me says, hey, I can't qualify you alone. Do you have a cosigner? Because that's what we call it in my world.
Okay, a cosigner.
Yeah. So the apartment complex says it's mandatory, and just because they're 18 or older, we want them. No, they're getting more people on your lease to guarantee the fact that you're going to pay them back. Because if you don't pay it as the primary, those two other people you put on the lease are in fact responsible. In my world, we call it a cosigner or a co-buyer that can help you mathematically qualify for the house. So yes, if they're going to help you pay it, or we're helping you pay it or offset expenses, it may be worth exploring.
Okay.
Or we may ask you to explore it, even though you don't want to, but that's the why behind it.
And speaking of cosigners, how often is that necessary or very helpful as far as someone qualifying for a home?
It can be very helpful for someone to qualify. When it comes to that, I am always one for the people, though, because I always want to ask, what's your relationship to this person? How does this look? Again, if you're going to be married, you are married, your children will live in your household long term or will inherit the property. That's great. But if you co-sign for someone, yeah, you're going to get a phone call if it's not paid, and you cannot just be removed from the loan. And I think that's more of the problem that I have seen, where a parent or a friend or a family member said, yeah, I'm going to co-sign with you. And a year passed, they're like, I need to get off. I can't just remove you. That person has to now make enough money to qualify for the loan on their own. And that is and have the credit to do so. It's both.
Got it.
And they have to be able to be standalone on that loan. So it is a long-term commitment to cosign. So you have to be willing to evaluate that and see if it checks the boxes for your specific scenario. It's another thing where one size doesn't fit all. It depends on the family dynamic and what you're looking to do. I see a lot of grandparents help their younger grandchildren and what have you, maybe co-sign. They're 70 some odd years old. They're not going to run out and buy a house. They're not in an urgent need to get removed from that because they have other business to handle on their own, or they're going to go buy a house. Those are the things you want to check for.
Awesome. All right. So co-signers, guys, is a great way of being able to qualify for more, especially if they're going to be living with you anyways. So that is awesome. Thank you, Mose.
You're welcome.
Okay, Mose. So car payments. I have had clients in the past, and I could definitely say that I have experienced this myself, where I go out and I get a nice fancy car payments between $600 to even $1,000. And then my client finds out that they can only qualify for a lower amount. And one of the major reasons is because of a high car payment. So what is it that we can, or that my viewers can kind of take from being able to keep that from occurring?
That's a great question. It's expensive outside.
Yeah, it is.
Okay. I'm going to date myself saying this, but I remember maybe like 7 years ago, 8 years ago, saying, I don't want a car payment over $350. I don't even think that you can make that happen with any car right now that's on the market. It's even hard to get a used car with a $350 payment per month. So you have to know that your right now is going to affect your long game with affordability in general in life. So whether you're renting, because they're looking at your affordability on renting, and because car payments are being financed 7 years, 8 years. I even ran into one this year for 9.
Ooh, okay. 9 years. Who can keep a car for that long?
A decade, pal. A decade. Okay.
Goodness.
Yes. And you don't even keep a car normally for that long.
Not at all.
It might not be working by that time, right? So the payment terms are extending.
Wow.
The payments are larger because of the cost of cars in general. So knowing that going out and buying a car will affect your next moves for renting or even owning a home. Because when they go look at those numbers and your affordability, that $1,000 car payment today is definitely going to impact you going forward. And I think it's a thing that people aren't thinking a lot about, that long game.
Mm-hmm.
And then when they come like, hey, okay, I'm good, I want to go get a house, but yeah, you bought a car and it costs $1,200 a month, but that's half of a house.
It really
Literally,
is.
it's half a house. So that choice, I know my first car, it wasn't fancy at all. It was not Instagram worthy.
Mine either.
No, not at all. It wasn't. It was barely rolling,
Mm-hmm.
but it got me from point A to point B. And I think there's something to be said about that. Or again, talk to your family members. Mm-hmm. Maybe there's the family member that has this great job, already has a house, is more established, and they have a car that they might think to trade in, maybe because you knew the owner and that they took care of it, figuring out what it might cost you to get that off of their hands. Because remember, if you trade in a car, that car dealership gives them a certain amount, but they give them an amount where they know they can turn around and still sell that car for more.
Right. Absolutely.
Okay? That's how it works. So again, me telling my business is my 22-year-old daughter, I had a car and we just could not find the math to be mathing on getting her another car to where she wouldn't be in a position to where it wasn't affordable. So as mom, I kind of took the hit. I said, well, you know what? I'll get a new car. I'll put more money down so where my payment's not sky high. Mm-hmm. And I will give you this car, because I knew for the money that they would buy the car for me, my daughter couldn't even buy that car for that amount.
Got it.
So I think, again, that family unit in these times where it's expensive outside do have to kind of come together on some things, or even if you know a friend, because often you can get that car from them instead of them trading it in, and it work as well.
Got it. So what you're saying is that it's about priority, yes, right? It's yes. Like, okay, let's get the house, and then we can get the car. If you're looking at having something, something nicer, knowing that the car payment is going to be higher.
Correct.
So it's like house and then car, not car and then house, because Correct. At that point, you're going to be very disappointed. You're either going to have Correct. To figure out how to make more money, yes. Yes. And you got to prove that, right? Correct. And it just makes it such an interesting thing. So house and then car.
House, then the car. And I did have someone ask me something very interesting. They told me when they were getting qualified for the house, what would it look like if I had a car payment for this amount? Would I still qualify? They knew that they weren't going to buy for maybe 4 months or so, but they did ask the right questions because they told me what the long game was.
I like that.
Okay. So the discussion in that assessing what your life looks like in home ownership is more important than just the right now. Knowing, and even when, I'm going to throw this in there, even when you go to get your taxes prepared. Okay.
True.
You go get your taxes prepared and you don't tell your accountant what your long game is. They're creating your tax strategy based on what you told them. And if you don't tell them in a year, I want to buy a house, in 2 years, I want to buy a house, they can't even give you effective strategy to be prepared for what you want to do. And sometimes it impacts how they file your tax returns, especially if you're self-employed.
That is so true. That is so true. And guys, and I just want to make sure that we're right about this, because tax season just finished, right? So for those of you who had filed taxes, it'd be great for the people that get their refunds. Hopefully they will look at purchasing a home before purchasing that car,
yes,
right?
Yes.
With those funds,
yeah.
Which would be great. But the other thing is to prepare the person who is doing your taxes and letting them know, hey, I want to buy a house. So then at that point, the tax people would be able to say, hey, we can't write off all this. I get that you don't want to pay the IRS all this money, right? But if you want to buy a home, here's what we have to do. Or do you feel that it is helpful? As a lender, do you guys work with the tax people to be able to help them understand like how that works, or what do they need to qualify for? Like, is there a bridge there or no? I
have talked to tax people. I can't tell them what to file on the tax return, but I can tell them what impacts the tax return. You can actually look it up online.
Okay.
Like I said, believe it or not, crazy enough, they'll tell you, hey, this is how we calculate self-employed income when it comes to taxes. And I tell people, the thing is that when they come to me, I said, you can't get mad at your tax person. In fact, their job is to leverage the tax law to your full benefit. Okay. If the tax law says you can claim certain things as a write-off, or you have donations, right? Or you bought equipment to do your job, or you drove a lot, so you can write off mileage and the expenses and insurance and all the things that you have, that's their job. They're supposed to find all the deductions for you they possibly can, or you'd be mad, right?
Right.
That's what you want. But at the same time, in planning, you have to work with your tax preparer to say, hey, but this is what I want to do, you know, in my future. And they can guide you along that as well. They will work with you. They just need to know beyond 2 weeks what your life looks like.
Got it.
And that's all. And I can do the same when it comes to mortgages. If you tell me your goals are simply to just buy a house, get into this house for the least amount of payment possible, or you want your payment to be X, and we don't talk about your next steps, it hinders me being able to help you as well, because you don't open up to me.
Got it.
I know we've talked about this a little bit before, but your first home, even though you're a first-time home buyer, it can be your first investment purchase as well. And we can always guide you to, in your case, get the home that's good for those goals. And in my case, the financing that's good for those goals, knowing they don't plan to be there for 10 years.
Got it.
Right?
Right.
It's just, we need to have the conversation. And it's important to really make sure you're working with somebody that's just not cranking out the right now if you have a bigger picture or a bigger goal to achieve.
Got it. I really like that. Mose, please share with us, how can they reach you?
You can call me. My number is 702-439-1174. You can text me at that number as well. And I have a website where you can see myself and my team that works for me. And that's at thegatlinggroup.com. What's amazing about the website is there's some free resources on there that you can get. Home buying guide, a credit guide, and an asset guide to kind of walk you through some of the things that we've talked to, give you a little bit more meat and potatoes to be able to get those things done.
Fantastic. Well, thank you so much, Mose, for joining us. And guys, we went over a lot of content here. And so I know that there's a lot of things that you may have further questions in. And if there are, please put it in the comments so that I can get them addressed, and we'll definitely bring Mose back. Because me and Mose, we can talk for hours about the lending process, what's going on, what's happening. And so I hope that you guys have enjoyed it just as much as I have. Mose, thank you so much.
Thank you for having me. I appreciate it as always.
And we are closing off. This has been just so amazing with Mose here today. Thank you so much. So for those of you, again, this is Cara Faine, your broker salesperson here in Las Vegas, Nevada, and financial expert. If you like this content, please like and subscribe and click the bell for the notification so that you'll be notified on the next video. I'll see you guys next time.